Hi everyone, we're now going to review problem 3-15. Hopefully you tried this on your own. Frøya Fabricator AS of Bergen, Norway is a small company that manufactures specialty heavy equipment for use in North Sea oil fields. The company uses a job order costing system that applies manufacturing overhead costs to jobs on the basis of direct labor hours. So remember, we usually know how much material, direct raw materials are used. We could pinpoint that. We know how much our labor costs because we could track it by hours. So the people who are directly involved in the production of the heavy equipment, we could track their hours. It's the other costs that are much harder to track. Things like the supervisor's salary, utilities, depreciation. These kind of items then are considered overhead. So instead of trying to track every little cent of overhead, we do it on a more general way of allocating the overhead through what's called predetermined overhead rates. So its predetermined overhead rate was based on a cost formula that estimated $360,000 of manufacturing overhead. So the total amount of all those other costs was estimated to be $360,000. And the estimated allocation base is 900 direct labor hours. So $360,000 results from 900 of direct labor hours. The following transactions took place during the year. The first thing we're going to do is prepare journal entries for each one. And that's what you see in front of us. So this takes us back to our Accounting 101. And so if you need to go back and practice debit and credit rules, now's the time to do it. Raw materials purchased on account, $200,000. So we're going to debit the asset, increase the asset raw materials or raw materials inventory, credit accounts payable because they purchased them on account. Accounts payable again is a liability, and we increase liabilities on the credit side. That's where we're storing amounts we owe to our suppliers. In B, now they took some of those raw materials and transferred them into production. 185,000 of them. So now we're going to debit the inventory asset account work in process. Remember, we now have a work in process inventory account where we keep track of all the amounts, the costs of items that are being processed right now. So we'll keep adding to that as we're processing them and costs are added. Decrease the inventory raw materials because it's no longer sitting on a shelf as a raw material, it's now in the work in process inventory account. Utility bills incurred on account, $70,000. 90% related to factory operations and the remainder related to selling and administrative. So now we're going to debit an manufacturing overhead account, part of our inventory, for 90% of the $70,000 because that's the part that's related to the factory work. The other 10% or $70,000 is a normal utility expense because it's part of selling, general, and administrative costs. So the part that is related to the actual manufacturing is debited to an inventory manufacturing overhead. And you'll see what happens with that account. Then we'll credit accounts payable because it was on account, so we have to increase that liability. In Part D, they accrued salary and wage costs. Remember, accrued is just saying something happened and we need to get it recorded. In this case, it's salary and wage costs. So the company used direct labor hours, 975, to actually produce and make the heavy equipment. That could be attributed. Those people actually worked on making the heavy equipment, their direct labor. So we're going to debit that account for $230,000. $90,000 of the salaries was for the indirect work or the manufacturing overhead related to making the heavy equipment. This could be salaries of the supervisors, the janitors, things like that. People that are part of the factory but are not directly making the heavy equipment. So they're called indirect costs. Those indirect costs are considered manufacturing overhead and are debited to that account. The remaining is for selling and administrative salaries. These are normal salaries expense then. So any cost of labor in directly making that product or even indirectly being a part of that process in the factory are debited to the inventory. The direct labor hours are put right into work in process inventory. We keep track of the indirect in this manufacturing overhead type of inventory account. We credit salaries and wages payable because these are accrued. Now, maintenance costs incurred on account in the factory, $54,000. So this would be debited to the manufacturing overhead account again, credit accounts payable, because it's an indirect cost in the factory. Advertising costs incurred on account would be debited to advertising expense. That's not part of making the product, that's part of selling the product. So we don't put it in an inventory account. Depreciation was recorded for the year of $95,000. 80% was related to the factory equipment and the remainder related to selling and administrative equipment. So that means 80% of the $95,000 is debited to the manufacturing overhead account. That's an overhead. That's not direct materials, it's not direct labor, but it is a cost of making the product. The other 20% will be debited to depreciation expense. That's not part of the making of the product. And then credit accumulated depreciation. Remember, that's where we keep track of all the depreciation taken on, in this case, the factory equipment and other equipment. In H, rental costs incurred on account, $120,000. 85% related to the factory facility. So there was some kind of rent that needed to be paid that related to the factory. So that 85% is debited to manufacturing overhead. The other 15% relates to selling and administrative. So that's a normal rent expense. And then we credit accounts payable for $120,000 because it was on account. So these were journal entries you learned back in Accounting 101. That's why it's a prereq. So please go back and make sure you understand why we're debiting and crediting. And let me know if you have any questions on that. Now, part I is where our overhead application comes into play. Remember, we apply overhead based on direct labor hours. So it's saying, what's your manufacturing overhead cost that was applied? How much should be applied out of the manufacturing overhead account into the work in process inventory account? Because that is how we record overhead into our work in process inventory. So what costs, indirect costs, these overhead costs, should be now become costs of inventory. Remember, we based it on the 900. So we said we will have a total of 360,000. That's our estimate of these of these manufacturing overhead costs if we have 900 hours of direct labor hours. So we actually apply overhead based on $400 per direct labor hour. Well, if you look back to Part D, how many direct labor hours were there? 975. So the application of manufacturing overhead will be take $400 per direct labor hour, our predetermined overhead rate, based on if we have 900 direct labor hours, it would be 360,000. But we had 975. So how much predetermined overhead should there be if there were 975 in direct labor hours? Multiply that by 400. So we take 390,000 out of the manufacturing overhead account by crediting it and debit our inventory account work in process. We've just now increased the inventory for all these other costs that are not direct labor or direct materials. In J, the cost of goods manufactured for the year were $770,000. So that means the total cost of everything that was brought through the manufacturing process was $770,000. So we will now transfer $770,000 of costs out of the work in process account and into the finished goods inventory because they're done. That's the cost that it took to make the products that were finished this year. Now in Part K, what happens when they actually sell some of this heavy equipment for $1.2 million on account? Well, we'll debit accounts receivable and credit sales for $1.2 million. The cost of the goods they sold, according to the job cost sheets, was $800,000. So we'll debit cost of goods sold, the expense account where we store the cost of the finished goods we sold, and we'll credit the finished goods inventory account. Okay, so it helps us to see how do all these costs come together. So in Part 2, they say make T accounts. And T accounts will give you the picture of all of these transactions. So we're going to take a look through the various journal entries so that you can see how they're flowing into the general ledger, which is our center of our accounting system. And you can look at your journal entries. Journal entry A, we debited raw materials. I'm going to have to scroll down. And we credited accounts payable to say we owed that. But really our focus is here. Here's our first inventory account, raw materials. Journal entry B, that B should be up here. I'm going to put it up there. Okay. Debit work in process. Here's where we transferred $185,000 out of the supply raw materials inventory and put it into production to make the heavy equipment. So once we start using the materials, we now transfer the cost of those materials into our work in process inventory. Credit the raw materials inventory, debit the work in process, because now we got to start collecting the total costs of making the product. And while it's in production, those costs are grabbed together in the work in process inventory account. In C, what happened in C? We had utility bills. We debited the manufacturing overhead account, $63,000. So this is where we're collecting all of those indirect costs of the factory and building the heavy equipment. And then we debited utility expense because that has nothing to do with building. That has to do with our selling and administrative departments. And then we credited accounts payable. In D, we debited sorry about that. Okay, we debited manufacturing overhead for the cost of salaries that are part of the factory but not part of direct labor. We debited the work in process inventory account for the cost of the people actually working on the heavy equipment, the direct labor, $230,000. The people who are in selling and administrative function have no part of making the actual product, so we just debit their salaries to salary expense. And then we credited, let's find it down there, salaries and wages payable. In journal entry E, we debited manufacturing overhead because this is an overhead cost of making the equipment, and we credited accounts payable. Journal entry F, advertising expense has nothing to do with making the product, so we debit advertising expense and credit accounts payable. Journal entry G, the depreciation related to equipment in the factory is debited to manufacturing overhead. The depreciation related to equipment for selling and administrative part of the business is debited to depreciation expense, and then accumulated depreciation is credited for the total. In H, the rental expense or rent costs associated with the factory, whatever it was they were renting, is debited to the manufacturing overhead. The part that is related to selling and administrative has nothing to do with making the product, is debited to rent expense. And then we credit accounts payable because it's on account. In I, we are now going to apply our manufacturing overhead based on a predetermined rate, $390,000. We're going to debit our work in process for $390,000, credit manufacturing overhead. Notice when we do that, we end up with a credit balance. We've actually applied more than we've actually paid for to this point. We'll correct that. In J, now the goods are done. We've collected all the costs associated with making the heavy equipment to this point. The stuff that is finished cost $770,000. So when the heavy equipment is done, we say, well, how much did the heavy equipment that's finished cost us? $770,000. Credit work in process, $770,000, and transfer that to the finished goods inventory account because it's done. Notice, there's still $56,000 debit balance work in process. What's that for? The items that have been started at this point but are not finished. They're still being built. So there's cost out there for stuff that's still being worked on. In K, when we sell some of the equipment, we debit accounts receivable, credit sales for the amount of the selling price, but we also have to debit our expense account, let me find it here, cost of goods sold for the cost of the equipment. How much did that equipment cost that we just sold? And then credit the finished goods. So now, after those transactions, take a look. Accounts receivable has a balance of $1.2 million. Raw materials, we still have $45,000 of materials that are waiting to be put into production. The work in process, I explained, that balance in that inventory account is saying, hey, there are goods here that are still being worked on. The cost associated with them right now is $56,000. How much in heavy equipment costs? How much did the heavy equipment that's still in inventory that's done and waiting to be sold cost? $30,000. Our accumulated depreciation and accounts payable will have balances and our salaries payable, but that's not our focus. It's really these inventory accounts. Cost of goods sold now is a debit balance in it of $800,000 because that's how much the inventory that we sold cost us. The manufacturing overhead will have a credit balance of $5,000 because we applied more than we actually had. And you'll see what happens with that in the future. Okay, and then we have our various expenses that resulted from these transactions. So now we could see how it all comes together in our T accounts. And remember, I didn't mention this, but some of our T accounts started with beginning balances, and they are listed right in that little blue box on page 131. Now, what's our next step? Prepare a schedule of cost of goods manufactured using this information. So I'm kind of going to scroll back and forth here, but here we go. Cost of goods manufactured is where we're showing how much everything costs that we manufactured. So direct material started. Remember, we always start with our direct materials inventory and we reconcile that. What does that mean? We say, where did we start the beginning of this period at? And they tell us the beginning balance of raw materials was $30,000. Then from our transactions, we bought $200,000 more. Okay. What was left? So all the raw materials that we could have used cost $230,000. Well, there were $45,000 left in raw materials. So that means we've put $185,000 of raw materials into production. So that's our first cost. How much in direct labor did we have? $230,000. Okay. Then we say, okay, what's the manufacturing overhead we applied? $390,000. So the total manufacturing costs that were put into the manufacturing process this period are $805,000. Okay, did we have any costs of stuff started last period that were still in production at the beginning of this period? And the answer is yes. So the balance of beginning work in process are for any items that were started last period but are still in production. Those are the costs that are coming into the new period. So the total cost of everything that was in the manufacturing process is $826,000. Then we say, was there any costs at the end of the period that are still, the items are still being worked on? And the answer was yes, we had $56,000. And that was right up here, work in process. We still have $56,000 of cost represented by goods that are still in the manufacturing process. They're not finished yet. So we subtract them. So the cost of the goods that were manufactured, finished, $770,000. So that is how we create just a schedule to show the cost of the goods manufactured. Now, prepare a journal entry to close any balance in the manufacturing account to cost of goods sold. So that's what we do. If we have a balance left after applying, according to the predetermined overhead rate, we zero it out by either debiting or crediting it. Well, our manufacturing overhead account had a credit balance after applying manufacturing overhead. So we have to debit it, debit the manufacturing overhead, the offset is increased, the cost of goods sold. So the manufacturing overhead account will have a zero balance, and it has to. So we collect all the manufacturing overhead actual costs in the debit. We apply and credit that account based on our predetermined overhead rate, in this case, $400 per hour. The next thing they ask us to do is just prepare the part of the income statement related to cost of goods sold. Now, cost of goods sold, we always start with beginning finished goods inventory, because that's what it relates to. So where did we start? How much were the cost of all the goods we could have sold, but we still had at the beginning of the period? And they give us that number of 60,000 on page 131. Add to that the cost of all the goods that were finished manufacturing this accounting period. And we figured that out. Those are the cost of the goods manufactured. So that's the actual cost of any good that was finished, all the costs associated with it, $770,000. So the cost of everything we could have sold was $830,000. Cost of goods that we could have sold were $830,000. We know based on our calculation above, right here, the cost of the goods still here at the end of the accounting period is $30,000. So we could have sold stuff that cost $830,000. We only have $30,000 left. So the cost of the goods we sold were $800,000. We still need to adjust cost of goods sold due to our overhead application. And since this journal entry said credit, we have to reduce cost of goods sold. So the actual amount of cost of goods sold will be $795,000. The final item is to create an income statement. So now this brings us back to our GAAP, Accounting 101. We start with sales, $1,200,000. Next, subtract the expense cost of goods sold. Its adjusted amount of $795,000. So the company sold the heavy equipment, bringing in revenue of $1.2 million. Those items they sold cost $795,000 to make. So the gross margin or profit is $405,000. Now, so that's what they made from selling the heavy equipment. The other expenses related to this time period are selling and administrative expenses. And these expenses in this area are taken right from our T account balances. So I'm just going to scroll back up right in here. So we had advertising expense of $136,000, utilities of $7,000, $110,000 in salaries expense, $19,000 in depreciation expense, and $18,000 in rent expense. So those various expenses must now be subtracted from our gross profit or margin. The total amount were $290,000, and we get our net operating income. Okay, and that's just showing how much income we made from making our product and selling it, our core business, $115,000. So that's a great problem to show you the various journal entries, how we apply overhead, how we create a cost of goods manufactured, how we determine just cost of goods sold so that we can create our income statement that's required by GAAP. Okay, so if you have any kind of questions at all, please post them to the discussion board.